It is what it is. Welcome to the closing beat, everybody. Happy Tuesday. How you doing? Hope you're all good. There's a lot going on. Like every time you turn around the corner, there's something going on, and I've got a lot for you here tonight. This is the closing beat. I've been notified that apparently thousands of homes in our area, there was a horrible storm that came by. We actually had little bits of hail. And so thousands of homes are without power. The storm has passed, but just in case I lose you guys, you know that it is just stormy out. Typical Florida in the middle of the summertime. Hey, that's why the audio is poppy. Again? Man. All right. Let's go louder so it pops a little louder, huh? Anyway, sorry about that. Yeah, it's been a rough day, internet-wise, power-wise, just all kinds of stuff going on. We are financial advisors here at Jazz Wealth. Thankfully, we work in the cloud, so if we had to go work somewhere else, we could. We manage our own funds. We really enjoy that, being able to add value in a different way than any other advisor out there. And we may have a little something special coming up in August for those of you around the retirement age or so. Got to talk with Eric about it. We'll see what's going on. Hey, Wine and Wealth, which will be Thursday this week as normally scheduled. I'm going to talk about what do I need to know about your life as it changes to help add value, right? Because we're not just, hey, we do investments and that's all we do. What are the little things that come up? So many people I've talked to over the summer, I don't know just because they have time to talk or whatever, but I've been able to help in so many different ways that have nothing to do with investments. It's so cool. So we're going to go over some of that stuff. Oops, I did that. As Thursday comes around, so be sure to join us there. FinTips, you know that our videos are free. They are up on our website there. You don't have to be a client there. Today I did a 401k loan trick when you have a loan and you want to leave your job, right? Rather than just suck it up and say, I'll take the distribution or whatever. Something you probably didn't know about there. Let's talk about the stock market because that's what's cool today. Economic data. It don't get any better. And that's as fancy of grammar as I can use. Not really the most interesting of economic data numbers that came out today. The rest of them come out later in the week. New home sales fell again. So it's now hit an annualized rate of 43%. And so now, since we have GDP numbers coming up, I go, okay, any data point that comes up, I'm going to bring up, was that in the middle of a recession? Did that lead to one? I mean, it's just kind of fun. There are 6 times in history where the new home sales have fallen at an annualized rate of 43%. 5 of 6 were already labeled a recession. The 6th was labeled a recession shortly after. We also had consumer confidence numbers come out there. They were less than expected as well. In the consumer confidence numbers, there's something called, like retail sales, we have all the different categories. In consumer confidence, they have categories as well. And the big one that everybody focuses on is jobs are plentiful. It's actually just called jobs plentiful, but I like to say jobs are plentiful. That fell another 1.5 there. Employment is weakening. That's a problem because that was the one crutch that we had to stand on. And if that is getting weaker, we want to know at the first sign of what it looks like, right? What's going on there. We looked at all the drops in the jobs are plentiful there because now we have fallen 6 points off of highs. So anytime that we've fallen 6 points off of highs, we look to see, was it a recession? Was it about to be? What's going on there? And turns out that all of them were either in a recession or within 3 months of a recession, right? So something you want to point out, or something I want to point out, take a look at. Okay, as far as the earnings here today, my God, there's a lot to do. Earnings continue to jostle the markets around there just a little bit. We've got the Fed coming up tomorrow, of course. Let's take a look at the markets. We'll start with the S&P here. We go over to, I got to go to Walmart. That wasn't really earnings, but it just came out of nowhere. So Walmart down 7% on the day. We'll talk about that in a little bit. Microsoft has come out with earnings after hours. They missed, which is fine, right? Remember the stats we talked about yesterday? It's totally normal. Right? Their second quarter is the worst for them. So now you know that what happened with their earnings is nothing new. It's not interesting. It's not odd. It's not, oh my God, the world is ending. No, it's just what their second quarters look like there. It is very normal for that to happen. Alphabet is the same exact thing. I love this because we just talked about it yesterday to show you that they were basically the same as Microsoft. So they missed as well. Not a real shocker. It's actually up a little bit. No big deal there. Chipotle comes out with earnings as well. The stock avoids disaster. Easily could have been a disaster earnings report there because sales are down, but prices are up. So remember, I've been talking about the focus this earnings season is profit margin growth, right? Chipotle didn't really do that. They said our sales are down, but our margins are staying the same because we're jacking up prices and people are still coming in the door buying these burritos. I know I will. I'll still be there. I will go without gas to go there. They can still raise prices. So it's very helpful. You can have less sales at higher prices and still meet your goals, which they didn't really, but they're working on it. And they said, hey, we'll do it again. If we have to raise prices again in August, we'll do the same thing. Right? So Chipotle stands out as rather interesting here. Now, before I move on, I want to talk about this real quick. So here is the SPY. Technical traders are going nuts about this rally because the bounce has been called a bounce on hot air. A dead cat bounce there. Lacks conviction. Those are all the quotes that you see out there because this bounce has happened on lower volume there. Remember, let's say, I'll show you this here. We're going to add a study. Hang with me. Let's add a study. Let's add volume average. Let me go over in here. Should be right about there. Okay. So now on your chart, what you see is the volume, same thing as you see up here, but we've got an average, a 50-day moving average plotted on top of it. I like mine to be blue, but for some reason it came up purple. Anyways, so we had one day during this last rally, one stinking day where volume was above average. See it there? I'll move out of the way. Other than that, below average rally. Technical traders like to go, oh man, that's not cool, man. That's not going to work. That means that the stock market's headed lower. Remember this one? I'll stretch it out a little bit so you can see better. S&P performance by volume. Below average days in black, above average days in blue. Below average days actually perform better than above average days. So I don't know if the stock market's last rally is hot air, lacks conviction, or is about to turn around and go back down. But I can tell you that historically, the investor wins when they participate in low volume days. You want a fun fact? I'll give you a fun fact here. If you take out all the above average days from the S&P for the last 10 years, that was as far as I wanted to go back. I had no interest in going back further because this took a while. Take all the above average days out and pretend you only invested on the below average days there, you would have beat the S&P's performance by over 10 times. And in the words of Biden, that's no joke. Right? It's no joke. The last 10 years, the S&P gains have been about 475%. If you take the cumulative days that are below average, you're up 5,776%, right? Above average days result in a loss of 90% just in the last 10 years there, right? This year, it's the same as well, just because I was there. The S&P is down about 18, above average days down 33. So if you said, I'm only buying above average bounces, you lost. Below average days are up 22%. So beating the market, and I should mention positive there. Just kind of a fun fact. Not that these are just things I like to point out. I'm not trying to tell you what to do and all that good stuff. So hang with me here for a second. I'm going to go ahead and get rid of this study. We don't need that anymore. We're good to go. We're back on our charts here. All right. The rest of the market, NASDAQ down 1.2%. You like it. You like a pullback. How do you not like that? Everybody that missed this below average, lacking conviction bounce, now you have that chance to start looking again. The Russell only down 0.5%. It's holding up better. Now, I've been wrong on the Russell because I've been interested in the Russell here lately. Haven't found my moment, but the Russell not pulling back. Hey, I can work with that. That's showing me relative strength in the small caps, the domestic stocks, the less exposed to the world stocks there and rates and such. Gold down 0.25%, not a big deal. Oil down another 1%. You like that, right? Remember, we say you don't invest in the bounce off the 200-day in crude oil. You can trade it, and it wasn't even that great of a trade so far, but you can trade it. You do not invest in it. See what's happening there? That bounce is not one that's very interesting. And to be honest, it looks like people have all moved over to natural gas. Holy cow, right? Russia steps up there. All of a sudden, you got a problem. All right, sector-wise, I don't have a whole lot here for you. I will spare you the efforts. You've got communication services hinting at a new low. Consumer discretionary was the worst of the day. It's continuing to pull back. Rate-sensitive stuff was higher today. Naturally, utilities, right? You can take a look at that. I do want to point out that the communication services now 214 days, which is about 10 months, without being overbought. Overbought by most indicators, whether it shows you this or not, is one standard deviation away from its 50-day average there. And we have not been overbought in 10 months. Is that interesting? That's a record. That's never happened before. And remember, the XLC is a communication services is a new sector where they kind of tore apart the telecom sector. Go back through telecom sectors as well. It has never spent 10 months essentially without an overbought condition. Kind of neat there. Okay, let's do a quick lesson here. We're going to do a quick lesson on sector rallies here. I intentionally left this blank. I want you to take a look at something. What are the returns over bear markets? Here's what I want to try to explain this here. These are all median returns. But if we were to compare the sectors that fell the worst and had a bear market rally, which ones should we invest in? In other words, everything's falling, but we want to look at the worst sectors that fell the most. On the next bounce, were they the best performers or were they the worst performers? That's all we're looking at. In other words, if there's a bear market decline, do you want to buy the dog sectors or do you want to buy relative strength? Here we go. So these are ranked in order 1 through 10, or 1 through 11, sorry. So the worst sector on the way down in a bear market had the best bear market rally. Bear market rallies tend to be bigger than normal rallies. I've explained that before. So the worst sector in a bear market rally has a median gain of 14% in terms of a bounce. The best sector in a bear market rally, those that has sold off the least, they look like they're holding up nicely. They still bounced, but only to the tune of about a 5% median gain there. In other words, this shows you rather quickly that the most oversold sectors when things are weak is where you want to be, right? Even if you're off by a little bit, you still get better performance than sticking with the best. That goes contrary to what I would have said. I would have said, look at the sectors that have held up the best. For whatever reason, they haven't fallen. Okay, great. You look like it's okay because they still give you nice median bounces there, but you missed over here where the better returns were, right? Now, when we turn the corner and we say, okay, now we're hitting that new bull market, right? We looked forward to see, was it the sector that had the worst performance on the way down that does the best on the way up within the first month? Or is it those that didn't fall as much? Do they tend to rally? Again, I would have got this one wrong. The sector with the worst decline on the way down was the best performer on the way up, 45.8% median returns there. All the way through, we're looking through the other sectors. The sector that did the best through the bear market downturn has almost the worst first month's rally out into the new bull market. So in short, it's not easy. But when you see the bear market fall and you look through all the sectors and you go, oh, there's some nasty ones out there, communication services and consumer discretionary, whatever, the worst ones give you the best bang for your buck on the way up. Now, there's a little skew there. Those of you that are smart enough and been around the block a little bit know that tech has a heavier weighting in the S&P. That's a lot of that. It's going to be in tech. But is that different? I like that. Just trying different things. Just trying different things, man. You got to keep it fresh. We're not going to do new highs, new lows today because there was only one new high and only one new low. Hasbro fell. That was largely due to Walmart. Remember, they had good earnings. They sold a lot of those Buzz Lightyear physical toys and stuff. So that was pretty good for them. But Walmart took them down today. And then you got Centene hit new highs. That was their earnings overall. That was the breakout we talked about before. It's just continuing because of earnings that were pretty good there. If we go on over to stocks in the news, I'm going to make my way. Yeah, let me know. Is that interesting or is that a waste of time? First up, we got Walmart. Not really earnings related, but Walmart's big news was they cut their profitability guidance. That's a big deal. It's freaking Walmart, right? Who doesn't buy something at Walmart? That's a barometer of the consumer. It's really kind of an interesting study there. As I was reading the report last night, because I was just curious, it wasn't a very long one. This is quoted from them directly. Increasing levels of food and fuel inflation are affecting how customers spend their money. Duh, you just don't think that Walmart's, you kind of feel like they're immune to it. Anyways, they go on to say inflation and fuel are affecting how consumers spend. And while we've made good progress clearing the hardline categories, extra inventory and such, apparel in Walmart U.S. is requiring more markdown dollars. In other words, they've got extra inventory. They're not moving it. They track every single thing. They do. They're not moving some of the inventory, meaning they've got to cut prices beyond their already low prices to move this inventory. What does that do? Hurts the profit margin. What is everybody looking at right now? Profit margin. Can you hold on to your profit margin, or can you increase that profit margin? Walmart saying, we can't. We got to bring it down. What does that mean for everybody else? If the granddaddy of all retailers can't do it, that may be a problem for the rest. We'll see more on them when they report next month, actually, so they got ahead of schedule. Whirlpool misses on sales, guides lower, basically to the lowest end of the range for them there. They said, we're seeing demand for appliances falling rapidly. Well, the number that I gave you in the beginning, new home sales falling at 43% annualized, that'd give you a clue that Whirlpool's kind of sucking wind there for a little bit. The weak housing market, they mentioned high input price, which is a fancy way of saying our costs. The inflation for their costs are not helping profitability much either. It could have been a lot worse there. I think a lot of people have priced in that this is as bad as it's going to be. I don't know, man. NXPI Semiconductors, this is interesting. So 31% increase in their inventories. Normally, that's not a good thing, but they see the demand. The demand is there in the cell phone electronic category, in the automobile category. We're all trying to go electric, and that requires lots of semiconductors inside of your new electric cars that you're buying out there. Demand in auto, industrial, and Internet of Things continuing to support and exceed our incrementally improving supply. So normally more supply is bad news, but when you have more supply and there's tons of demand out there, that's awesome for them. The stock ultimately was kind of flat on the day. Not too bad, considering how bad it was for some of the other semiconductors out there. Alibaba, they've been talking about this for a while. They're going to list in Hong Kong. So they're listed here. They're listed in Hong Kong. They're just trying to get more exposure to rather wealthy people to be able to invest in their stock. McDonald's. This is just an interesting technical note here. So McDonald's earnings came in better than expected. All is good there. Profit margins held. Profit growth is not quite there, but nonetheless, they did all right. The stock's up 2.6% on the day. I found it interesting because of the technical reversal there. You now have a reversal that's almost back over 5-month, not consolidation, but 5-month highs, essentially. That leaves room for people to start believing that McDonald's has the ability to go to $270. Is that a fair risk to reward? Well, when the risk is exceedingly high in the stock market right now and rewards are very minimal, you'll take a smaller reward in exchange for the same amount of risk. In other words, McDonald's right now, from where it stands, it's a 1-for-1. You're risking the same amount you're going to return. You never really want to do that. But when there's no other returns to be had, maybe people are willing to accept 1-for-1. That's my take on what's happening with McDonald's. All right, if you can get 2.5 or 3 times your risk, you almost can't mess this game up. Right? I did a class on this in the dojo, if you're interested, where we talked about risk versus reward, how to quantify that so that you don't have to be as successful picking stocks. That's a big deal because it's not often someone's very good at picking stocks. So let's go ahead and just get that out of the way and make it work for you. All right, that's all I got for you there. We do have a meeting at the Tampa office here tonight, so I do have to get rolling in a little bit. But if you have questions, I'm happy to stick around and try to answer your questions and see what I can do there. Make sure I covered everything for the day. Yeah, I did. Tomorrow's earnings: Boeing, Bristol Myers, Humana, Kraft Heinz, Sherwin-Williams. Remember the news we got today. T-Mobile, Ford, Lam Research be in your semiconductor space there. O'Reilly Auto Parts, and Qualcomm, sticking with some of the semiconductors there. Yeah. Yep. What do you guys think? Is it going to be a recession? From the traditional number, you see what they're doing on trying to. I would do it too. I'm not blaming them for it. If I was in Washington, I'd be saying the same thing. Like if I knew the inflation or recession numbers were, the GDP numbers were not going to be good, I'd try to talk my way out of it too. Yeah, I mean, you can't blame them, but it's kind of nonsense, right? You guys see through that. Oh man. Also, the Fed tomorrow. That'll be our main focus, of course. Kareem, what's your opinion on where the growth sector growth stocks are heading. I assume many won't reach their all-time highs ever again. I don't know about ever again, but no time soon, right? You can't have growth stocks hitting. You won't have growth stocks hitting new highs in a rising rate environment. There's a period of digestion with these new rates there. They'll find clever ways to raise more money, to continue their growth. The world will move on. But for the moment, yes, there's a digestion period. So what do you do? You know, how do you make that call? That's why you don't see any of them. Yeah. Thoughts on the press release? Oh, I just covered that. Yeah, I think that's sort of nonsense, to be honest. I mean, I hope we're not in a recession, right? You want to see some level of growth. Okay, fine, right? We all spent a lot of money. We're not spending as fast. I get all that. But to come out and say, we'll tell you when we're in a recession. Our economists know what's going on. We don't want to rely on the traditional two-quarter GDP number that we normally talk. No. Let's let our economy. Honestly, I would do the same thing if I were running the country. You know what I mean? No, all of you would. You know, you're trying to keep good face, and I get it. But come on, man, that's a long shot, right? It's a long shot. Yeah. You got the press conferences. They're going, we don't know about these GDP numbers. I saw Biden say there'd be no recession. But again, I mean, is he going to say yes? You know, that any president, that'd be the wrong thing to do, is to say, yeah, I feel like we're in a recession. This sucks. Because the blame is on the president, right? No matter who it is. So I don't think anyone would ever admit to it. But, it's a fun world we live in. I like watching the banter back and forth. Could care less otherwise. You switched to a job as working as an auditor. Oh, okay. There's a fun saying I was telling Eric earlier. I don't know who it's from. I'm not taking credit for it. But I want to say it was a president that said a recession is when your neighbor loses their job. A depression is when you lose your job. And it's true, you know. Recessions are interesting characters, they are. Well, thank you for the comments, James. I do like to teach. Sometimes I miss the target. I'll give you that. I just take random shots at what I think you guys would be interested in each night. Usually has to do with something I'm preparing anyways. And I don't know. You know, I like to take a shot there. We will see. How will Roku do on earnings? Can it get any worse? You know, like you don't bet on it going lower for earnings. I don't see how you do that. So I just don't see how it gets any worse. Down today, I think it got downgraded because somebody was believing it was a normal bear. There was an analyst that's normally quite bearish. Wolf Research, I think is what they call themselves. I don't see how it gets much worse, man. You know, even if they just kind of say, well, things are coming around, supply chain issues are not such a big deal. Any glimmer of hope, you think people are going to say, well, that's the bottom. But obviously, I have no idea. Was it Reagan that said that? All right. He was known for a quote or two, huh? Well, if that's true, thank you for that. It sounds familiar because I wanted to say it was a president, but I can't remember. Yeah. Ooh, going with the trans talk there, huh? What is true then? Is it a recession? I don't know. Anyways, I'll wrap it up there. I appreciate you guys following along. I know I don't always have maybe what's interesting, but if I can get you to think a little bit differently, you see something, maybe you'll remember it. That's cool. We're done. That's it. We're done. All done now. See if it comes back so I can say bye. There you go. I think it's back now. Sorry about that. Storms in the area. Anyways, I'm going to wrap it up there before we get kicked out for good. Enjoy the rest of your day, and thanks for hanging out with us. We'll be back tomorrow, I hope.